Most people think becoming a better investor means watching more charts, reading more headlines, and making more trades. But what if that's exactly backwards? Here's a surprising fact. Warren Buffett has said he spends about 80% of his working day reading, not trading, not staring at stock prices, reading. So why do the world's greatest investors seem to spend more time turning pages than clicking buy or sell? Today, I'm joined by one of the leading voices in investing psychology, behavioral finance, and long-term wealth creation. With decades spent studying the habits of history's greatest investors, our guest has uncovered why reading, not trading, may be the single greatest competitive advantage in investing. So let me ask you this. Why do great investors read more than they trade?
Because every trade is a decision, but every great decision begins long before you place an order. Most people think investing is about predicting the future. In reality, it's about improving the quality of your thinking. Reading is how that happens. Imagine two lumberjacks. One spends the entire day swinging a dull ox. The other pauses regularly to sharpen his blade. From a distance, the first looks busier, but by sunset, the second has cut down far more trees. Reading sharpens the investor's mind in exactly the same way. Here's what many people miss. Markets don't reward activity. They reward accuracy. And accuracy comes from understanding businesses, history, human behavior, and your own emotions. Look at Warren Buffett, Charlie Munger, Howard Marks, Peter Lynch. They're all obsessive readers. They aren't collecting facts for entertainment. They're building mental models. Every book, annual report, biography, or economic history adds another lens through which they see opportunities others miss. Now, here's the fascinating psychological part. Every day the market tries to trigger your emotions. Fear whispers, sell before it's too late. Greed shouts, buy before you miss out. Reading acts like emotional insulation. It reminds you that market crashes have happened before. Bubbles always feel convincing while they're inflating, and patience has historically rewarded disciplined investors. Think back to the dot-com bubble or the 2008 financial crisis. Investors who had studied history recognized familiar patterns. They understood that panic and euphoria repeat because human nature rarely changes. Those who only watched prices reacted emotionally. Those who had read deeply responded rationally. Knowledge compounds just like money. Read one good investing book and you gain information. Read 100 and you begin seeing invisible connections. Suddenly, a news headline isn't just news, it's context. A falling stock isn't automatically a bargain. A rising stock isn't automatically expensive. You start asking better questions instead of chasing quick answers. That's why great investors rarely rush. They're not competing to make the most trades. They're competing to make the fewest mistakes. Sometimes the most profitable investment decision is simply waiting while everyone else feels compelled to act. There's another paradox. Reading doesn't just teach you about companies. It teaches you about yourself. You discover your biases, your blind spots, and the emotional traps that quietly destroy wealth. In many ways, the greatest opponent you'll ever face in the market isn't another investor. It's the impatient version of yourself. So if someone wants to improve their investing today, I'd give them a simple challenge. Before making your next trade, spend an hour reading something that expands your understanding. Over time, you'll realize you're no longer reacting to the market. You'll be interpreting it. And that's the quiet advantage shared by history's greatest investors. They don't win because they trade more. They win because they think better.
That's a powerful perspective. The biggest takeaway is that successful investing isn't measured by how often you act. It's measured by the quality of your decisions. And quality decisions are built on knowledge, patience, and self-awareness. Thanks for joining us today, and thank you all for listening. Until next time, remember, the market rewards informed conviction far more often than constant action. Keep learning, keep thinking, and let your knowledge compound long before your money does.